In this chapter, Trading Strategies, we've explored some of the most powerful trading strategies, from trend following to mean reversion, from arbitrage to systematic risk management. Each of these strategies has provided you with a toolkit, a way to think about markets, and a framework to act decisively when opportunities arise. And now, as we reach the final tip of this chapter, we enter a world where strategy meets technology, where human decision-making merges with the speed, precision, and power of machines. We are talking about algorithmic trading, sometimes called algo trading, or automated trading. Pause for a moment and imagine this: a market that never sleeps, prices moving in milliseconds, opportunities flashing across screens faster than any human could react. Algorithmic trading allows you to tap into this reality, to execute trades with speed, accuracy, and consistency that simply isn't possible manually. But it's more than speed. It's about discipline, data, and execution. It's about building a system that removes emotion, that follows rules, that responds to market signals with precision and repeatability. And in this tip, we're going to explore not just what algorithmic trading is, but how it works, the strategies you can use, the challenges you'll face, and how to integrate it into your trading mindset. Algorithmic trading is, at its core, rules-based trading executed by a computer. It relies on algorithms. Think of them as recipes. Each recipe tells the computer exactly what to do when certain conditions are met. For example, you might have a simple trend-following algorithm. If the short-term moving average crosses above the long-term moving average, buy. If it crosses below, sell. It's simple in principle, but when you add the speed of execution, backtesting across thousands of historical scenarios, and precise position sizing, the potential becomes enormous. Now consider the human side of trading. When you trade manually, emotions sneak in. Fear, greed, doubt, hesitation, they all influence your decisions. An algorithm ignores emotions. It follows the rules, every time. It doesn't panic when a stock drops 2% in an hour. It doesn't get overconfident after a winning streak. That is the power of algorithmic trading: consistency. Pause here and let that sink in. Imagine being able to act decisively, every single time, with no second guessing. That's what a well-designed algorithm gives you. But with great power comes great responsibility. Algorithmic trading isn't one size fits all. There are multiple strategies, each with its own principles, applications, and risks. Trend-following algorithms track market momentum. They detect when an asset is moving in a particular direction and ride the trend until it reverses. Think of it as surfing a wave. The wave is the trend, the algorithm is your surfboard. Timing, balance, and discipline are everything. Too early or too late, and you wipe out. Arbitrage algorithms look for price discrepancies between markets. For example, imagine gold trading at $1,950 in London and $1,960 in New York. An arbitrage algorithm can buy in London and sell in New York simultaneously, capturing a profit. On the surface, it sounds simple, but in reality, opportunities exist for milliseconds. The algorithm must act instantly, considering transaction costs, execution speed, and market liquidity. Market-making algorithms provide liquidity by continuously quoting buy and sell prices. They profit from the bid-ask spread. Think of a market maker as the host of a bustling marketplace, always ready to buy from one trader and sell to another, keeping the market fluid. Algorithmic market-making removes human hesitation from this process. Mean reversion algorithms identify when prices have deviated significantly from historical averages. They buy when prices are unusually low and sell when prices are unusually high. This strategy requires patience and statistical rigor. Not every deviation returns to the mean, but over time, patterns emerge. Statistical arbitrage uses complex models to exploit relationships between correlated assets. For instance, two stocks in the same industry may usually move together. If one diverges, the algorithm detects this and takes positions to profit when the historical relationship reasserts itself. High-frequency trading operates at the extreme edge, executing thousands of trades in milliseconds. Here, infrastructure, latency, and speed become the competitive advantage. Only the fastest systems with the best data can profit reliably. Take a moment to imagine all these strategies running simultaneously in a market. Algorithms buying, selling, scanning, analyzing every second. It's a symphony of data and execution, and you, as the trader, orchestrate the music. For an algorithmic trading system to function, 5 core components are essential. First, a data feed. This is the lifeblood of your algorithm. Without real-time and accurate data, your algorithm is blind. Price data, order book depth, volume, volatility, all these signals feed your system, enabling it to make decisions in milliseconds. Second, a robust trading platform. This is where your algorithm lives and operates. It must be reliable, fast, and capable of handling the integration of your code with market execution. Third, the backtesting environment. Here, you test your algorithm against historical data. This is where mistakes are revealed, and parameters are refined. Think of it as rehearsal before opening night. You want the algorithm to perform flawlessly in the real market, so backtesting is critical. Fourth, the execution system. This is the bridge to the market. It takes the algorithm's signals and turns them into orders. Speed and reliability are crucial because milliseconds matter. Finally, risk management. Even with automation, the market can surprise you. Algorithms must incorporate stop losses, position sizing, diversification, and limits on exposure. Risk is not eliminated, it is managed. Let's bring this to life with Jane's story. Jane was a professional trader, frustrated by the emotional roller coaster of manual trading. She decided to embrace algorithmic trading, focusing on a trend-following strategy for the euro to US dollar currency pair. She began by defining her strategy, a moving average crossover. Buy when the short-term average crossed above the long-term, sell when it crossed below. She collected 5 years of historical data and meticulously back-tested her algorithm, tweaking parameters, analyzing drawdowns, and assessing win rates. When she moved to live testing, she first used a simulated environment. Every day, she monitored performance, ensuring the algorithm reacted as expected. Only after a month of consistent results did she deploy it in live markets. Over 6 months, Jane's algorithm performed exceptionally. It captured trends consistently, executing trades faster and more accurately than she ever could manually. But she remained vigilant. Markets change, patterns evolve, and her algorithm required periodic updates, constant monitoring, and adaptive risk management. Jane's journey illustrates a critical lesson. Algorithmic trading magnifies both strengths and weaknesses. Done right, it provides speed, precision, and consistency. Done carelessly, it can amplify mistakes, leading to significant losses. No discussion of algorithmic trading is complete without acknowledging the challenges. Technical issues can disrupt an entire strategy. Servers crash, connections fail, software bugs appear. Even a small glitch can lead to substantial financial loss. Market risks persist. Extreme volatility, sudden news events, or structural breaks can render algorithms ineffective. Algorithms cannot foresee geopolitical shocks or unexpected market closures. Overfitting is a silent danger. Optimizing an algorithm too much for historical data can create a system that looks perfect on paper but fails in live markets. Adaptation is key. Regulatory compliance is essential. Algorithmic traders must follow rules and reporting requirements to avoid penalties or legal issues. Finally, cost is not negligible. Setting up and maintaining an algorithmic system, including hardware, data feeds, programming, and monitoring, requires resources and commitment. But for those who invest wisely, the rewards can outweigh the costs. As we conclude this chapter on trading strategies, let's take a step back and synthesize the lessons. We began with trend-following strategies, learning to ride market momentum, We explored mean reversion, understanding the statistical tendency for prices to return to historical averages. We examined arbitrage, the art of exploiting market inefficiencies, and finally, we delved into algorithmic trading, where speed, precision, and automation amplify every strategy. The underlying thread across all these strategies is discipline, data, and risk management. Every successful trader, whether manual or automated, relies on these principles. Emotion is the enemy. Consistency is the ally. Reflect for a moment. Imagine combining all these strategies in a coherent approach. A trader who understands trends, spots mispricings, applies statistical analysis, and leverages automation is not merely reacting to the market, they are participating in it with mastery, intention, and preparation. As you move forward, consider this: strategies are tools, but mindset is everything. Whether you trade manually or algorithmically, your ability to observe, analyze, adapt, and execute will determine your success. Use the knowledge from this chapter not as a prescription, but as a foundation. Test, refine, learn, and grow. And remember, in trading, the market doesn't care about your intentions or emotions. It rewards preparation, execution, and disciplined action. Let this chapter's lessons guide you toward building systems, mental, strategic, and technological, that put you in control of your trading journey. Take a deep breath, reflect on your progress, and get ready to apply what you've learned. Every tip you've explored is a building block. Algorithmic trading is the pinnacle, not because it is magical, but because it allows the principles we've discussed, trend, mean reversion, arbitrage, risk management, to work faster, cleaner, and more consistently than ever before. This concludes our chapter on trading strategies. Take the insights, the stories, and the frameworks, and transform them into action. Your journey as a disciplined, strategic, and forward-thinking trader continues from here.
Thank you for listening to the Ultimate Trading Podcast by Bells Forex AudioWorks. If you love this episode, hit follow, leave a quick rating, and share it with one trader friend. It really helps. Right now, head to bellsforex.com/tools. 6 professional-grade trading tools, 100% free, no sign-up. Use them on every trade. They're that good. Full guide is free at bellsforex.com or grab the Kindle version on Amazon. Until next episode, trade smart, stay disciplined, and keep building your edge. Happy trading!